An introduction to 1031 exchange basics and the delayed exchange time deadlines. I'm Scott Saunders, and I'm a Senior Vice President with Asset Preservation Incorporated. Asset Preservation is a leading national 1031 exchange qualified intermediary. We facilitate 1031 exchanges nationwide. And at the very beginning of this presentation, I want to let you know that it's important that each investor, each taxpayer business owner, that you review your specific situation with your tax and legal advisors. And ideally, this is done well before closing on the sale of a relinquished property. We're going to cover an overview of 1031 exchanges. And so I'm going to pack a lot of information in a short period of time. I want to let you know that I'm not going to go into great detail on any one particular topic. But for those of you that are new to 1031 exchanges, I think you'll get a good introduction to what they're about, the time deadlines, and the process involved. 1031 exchanges are a vital part of the code. And you hear the name 1031 exchange, sometimes they're referred to as a tax-deferred exchange, 1031 exchange, 1031 tax-deferred exchange. They all come from a part of the Internal Revenue Code. So you'll see at the top of the screen, IRC Section 1031 exchanges. That's the code section that provides the guidance for this tax strategy. And this is a vital aspect of the tax code, and it provides real estate investors with a significant tax advantage, the ability to defer taxes on the sale of any property, any real property, held for productive use in a trade or business or for investment for any other real property held the same way. And what it does is it allows taxpayers and business owners to potentially defer up to 4 levels of taxation that would otherwise be incurred if the investor did not do a 1031 exchange. And finally, an important aspect, 1031 exchanges have been a vital aspect of the tax code all the way back to 1921. And so at 1031, the rationale is really that there's a continuity of investment liquidity, that a taxpayer gives up a real property that they're holding for investment or using in a business, and they're reinvesting into another, what's called like-kind property, what's called a replacement property, held the same way. So the investor is not actually receiving cash, they're just going from one investment property and then receiving back another investment property. So until the investor sells for cash, they don't have a taxable event. So it's a very, very powerful tax strategy for business owners, for real estate investors to improve investment returns. We have what we call right now the perfect storm for 1031 exchanges. And really that's being driven by a couple of factors. One is we're seeing much, much higher capital gain taxes. And when I say much higher, from 2013 on, capital gain taxes are higher. And then you'll see with the second bullet point, we actually have a new tax, what's known as a net investment income tax, that's imposed on certain high earners that it is imposed with capital gain taxes. So we've got much, much higher tax rates that real estate investors are facing. Now, coupled with that, we've got very strong markets. The commercial real estate market has been very robust, very strong for many, many years. In fact, right now the market is up about 33 to 34% over the previous commercial market peak way back in 2007. And then residentially, nationally, we've seen, the market's recovered since the downturn. We've got a very strong residential market in most areas of the country. So we have investors that have seen significant appreciation in prices. That's also led to rising rents. So the bottom line is we have taxpayers, any taxpayer that owns a property held for investment or one that they use in their business, they're looking for ways to potentially defer paying taxes, so pushing that tax liability into the future. And so they're exploring more and more 1031 exchange tax deferral. Now, there are a lot of reasons why people look at doing an exchange, and I'm going to go through a few of the motives. One is obtaining more leverage. If a taxpayer has significant equity in a property, they may not be getting the best return on investment. So maybe a taxpayer that's all equity or very close to free and clear, they can exchange out of that asset and acquire other property with leverage and get a better rate of return. Some taxpayers use a 1031 exchange for diversification purposes. And there are really two ways to do that. One, a taxpayer can diversify geographically. So if a taxpayer owns a lot of properties in one marketplace, they may want to exchange out to another marketplace, maybe even another state, to take advantage of different economies there and have the potential for some diversification. Sometimes investors look to diversify by asset class. A single family investor may want to exchange into a multifamily property or maybe an industrial or commercial property. So you can diversify both geographically and even diversify by asset class, exchange into things like self storage, industrial, office buildings, multifamily, etc. Consolidation is a very popular strategy. There are many real estate investors nationwide that start with single family homes, and they might acquire a portfolio of many single family homes, but later on want to consolidate that into one larger investment, maybe into an apartment, a multifamily building, or an office building for ease of management, and maybe one that's even close by. Cash flow. Maybe there's a real estate investor that has a piece of land with a lot of equity in it, but it's not producing cash flow. An exchange allows that real estate investor to exchange out of that raw land into income producing property where now they've got cash flow. Management relief might be a situation where investors come out of many properties, maybe many single family rentals, and exchange that into a larger multifamily or office building. Some investors want to increase depreciation, so a taxpayer can go up in value, acquire a larger building, and then get some additional depreciation benefits. And then finally, estate planning. Some taxpayers may have a lot of their equity in one large property, and maybe while they're alive, they want to do some estate planning and take advantage of a 1031 exchange and acquire multiple smaller properties to really kind of plan for the future with their heirs down the road. Let's look at capital gain taxation because this is an area where a lot of investors don't understand all the potential taxes that they might face. Taxpayers face potentially four different levels of taxes. So, taxes are first assessed on any depreciation recapture, and that's at an even higher rate, at 25%. So, if a taxpayer owns a property for, let's say, 20 years and they've depreciated it, and they do not do a 1031 exchange, they're going to have to pay taxes at a rate of 25% on that depreciation recapture. Now, the remaining economic gain is taxed at the federal level at either 15% or 20%, depending upon the taxable income of the taxpayer. And then the third one, this is something that affects many high earners. There's what's called a net investment income tax. So this is a 3.8% tax that is really assessed on higher earners. So single filers with over $200,000 of net investment income, married filing jointly at over $250,000. So certainly people that own larger commercial properties or have held property for a long time may face this. Capital gain, by the way, is included in net investment income. And then finally, the applicable state tax rate. So those of you that are fortunate enough to live in a state that has no state taxes have an advantage. And there are a handful of states that have no state taxes at all. However, there are a number of states that have very high state tax rates. A handful that I'll mention: Illinois, New Jersey, New York, California, and there's some others. The highest state tax rate in California is 13.3%. So the important thing to keep in mind when you look at capital gain taxation is as a real estate investor, you could potentially face all four levels of taxes. And what you find is when you add up all four levels of taxes, there may be a significantly higher tax hit than you were initially thinking, meaning it's going to eat into that projected profit that you thought you'd have. And that's why investors really are turning more and more to 1031 exchanges as a tool to improve their rate of return and to really push that tax liability into the future. Now, as a real estate investor, you really just have three strategies with your real estate. One is a buy and hold strategy, and many taxpayers will do that. Buy a property, hold it for the long term, pay down the mortgage, slowly bump up rents. The only thing that I want to suggest here is if you happen to have a lot of property in a part of the market where there's not a lot of job growth, not a lot of economic expansion and appreciation, not much upward pressure on rents or prices, it may make sense to consider exchanging out of that area and into a part of the economy or a part of the country where there's a lot of job growth and appreciation. So that's something to consider. Now, the second strategy is to sell a property. So sell the property and pay all of the taxes owed. So potentially pay all four levels of taxation that we reviewed on the previous slide. Now you have the after tax equity that you can invest into things outside of real estate. So stocks, bonds, mutual funds, energy, commodities, other types of investments. And just to let you know, there are many investors that do this, and this might be part of a long-term strategy to diversify out of real estate. The one aspect that I want to point out is that it's very difficult to obtain the same rate of return, the same ROI with after-tax dollars that are invested outside of investment real estate versus keeping all of the gross equity and redeploying that into another investment property. So purely from a return on investment standpoint, there might be a little bit of an economic hit doing this. Again, many investors do want to, down the road, diversify out of real estate, and they're just postponing that tax liability and pushing that into the future. And there comes a point in time when they want to go ahead and liquidate some real estate, pay the taxes owed, and that's part of a long-term strategy. And then finally, Section 1031, a 1031 exchange. Real estate investors can do a fully deferred exchange. That's where they pay no capital gain taxes and defer all of those taxes, or some investors opt for what we call partial tax deferral. They may sell one property and buy one or two replacement properties, but receive some cash out of the transaction. That's called cash boot. So pulling money out is always called, pulling cash out specifically is called cash boot. That's taxable. If that taxpayer has a reduction in their mortgage liabilities, that's called mortgage boot, and that's also taxable. But many investors may proceed with a partially deferred exchange and really take advantage of what a Section 1031 exchange offers and also pay some taxes on that boot. So that's another strategy that's available. Let's just take a quick look at the actual tax code itself. The tax code says this: no gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of a like kind, which is to be held either for productive use in a trade or business or for investment. So some key takeaways looking at the code. Number one, in the first line, this is what we call non-recognition treatment. So the tax liability follows the taxpayer from the relinquished property, and that basis gets rolled over into the replacement property. So the taxes don't go away. And so sometimes you hear the misnomer, the term a tax-free exchange. I don't care for that personally because it's not tax-free, it's tax-deferred. We're just pushing the tax liability into the future. So we call it non-recognition treatment. Now, the types of property that qualify are very broad. It could be an investment property for an investment. It could be a business property for another business property. It could be an investment property for a business property or a business property for investment. So a lot of options there. And when we look at the whole concept of like-kind property, which we'll look at shortly, like-kind property is very, very broad. So it's only real property. I mean, real property is real estate. It has to be real property, a real estate interest. Personal property no longer qualifies for 1031 exchange tax deferral. Now, there's some exceptions in the code that I'll talk about, just a couple of them. The first, stock in trade or other property held primarily for sale. So stock in trade is typically going to be inventory held in the ordinary course of business for sale to customers. So it could be somebody like a home builder, somebody like that who's just holding inventory to sell it. Or other property held primarily for sale. So if the intent of the taxpayer is to hold for sale, not long-term investment. And when we say long-term investment, we really mean generally rental income, unless it's bare land. So for rental income, then that property is excluded. And in the world of real estate, many of you are probably familiar with the term fix and flip, where somebody gets the property, and maybe they get it at a real favorable price. They fix it up, take a month or two to fix it up, and then they put it right back on the marketplace, marked up for that short-term profit. That type of property, if it's held for sale, even though the taxpayer makes a profit on it, that is being held for sale purposes, not for long-term investment, and it's excluded from Section 1031 tax deferral. Now, I want to draw your attention to the fourth bullet point down. An interest in a partnership is excluded from 1031 exchange treatment. So a partnership interest or an LLC member interest, you cannot exchange out of a partnership interest or LLC member interest. You cannot exchange into a partnership interest or LLC member interest. So keep that in mind. Now, any entity at the entity level can do a 1031 exchange. So if a partnership would like to do a 1031 exchange at the entity level, they can. The partnership relinquishes a property held for investment and then acquires a replacement property held for investment. So any entity can, a partnership can, an LLC, a S Corp, a C Corp, a trust, an individual. However, sometimes with partnerships and LLCs, you might have, let's say, 3 partners in a partnership. 2 want 1031 exchange tax deferral. 1 wants to sell for cash. Well, you can't do an exchange on a partnership interest. So those 2 that would like to do a 1031 exchange cannot do it on their partnership interest. Now, there's some strategies and some ways to address this beyond the scope of an introductory presentation. So certainly call asset preservation. We would be more than happy to review ways that you can handle partnership and LLC situations when certain partners or LLC members want to go their other ways. So just keep that in mind, but you cannot do an exchange on a partnership or LLC member interest. Now, the next slide is a real important one. This is a visual showing all the different types of like-kind real property. And when you look at the slide, you can see a lot of different types of assets. You see on the upper row, a farm, a single-family home, an office building. And then as you go down, you see all sorts of other types of properties, a rental vacation home, bare land, an office building, retail, industrial, multifamily, and the list goes on and on and on. Real property, any real property held for investment can be exchanged for any other real property held for investment purposes. And the definition of real property, it can be fairly expansive and broad. Things such as easements can qualify. So conservation easements, agricultural easements, what's known as a perpetual communication easement, a cell tower can qualify. In certain situations, things like certain oil, gas, and mineral rights can qualify for 1031 deferral. Air rights, what we commonly call a transferable development right, can qualify. So like-kind property, when we deal with real property, is very, very, very broad. Anything can be exchanged that's held for investment can be exchanged for anything else held for investment. Sometimes people have that misconception that if it's bare land, you have to acquire bare land. And that's not true. So you can go out of bare land into an income property. You can go from a single family rental into an office or industrial or retail. They're all considered like kind. When we look at what types of real property are excluded, there really are just 2 different types. First off, the house that a taxpayer lives in, their principal residence, that does generally not qualify as like-kind property because the taxpayer lives in it. Number 2 would be any property held for sale. So if the intent of the property is to hold for sale, not long-term investment, that is also excluded. Sometimes you'll hear that referred to as dealer property. Any other real property that is held for productive use in a trade or business or for investment can be exchanged for any other real property held for productive use in a trade or business or for investment. So there really are a lot of alternatives available to investors. Now, on the next slide, I want to cover something that we hear questions on quite a bit at Asset Preservation, which really revolves around the question of, well, how long do I need to hold a property before it's considered held for investment? And really the issue is more than just the time period. It really comes down to what is the intent of the taxpayer? And is their intent to hold for investment or not? So the intent is very internal, right? It's subjective. So we find that the IRS and the tax authorities, they're going to look at objective and provable facts that either tend to support the intent to hold for investment or contradict it. So either way, and they're going to look at all of the facts and circumstances. So each taxpayer's unique situation and their unique facts and circumstances is what the IRS is going to look at. So, is the time period important? Of course it is. But there is no set time period that you have to hold. It's really just one of many factors. So, in a perfect world, it would be ideal to have many factors and attributes showing that the intent is to hold for investment versus another intent. And to the extent that you have a lot of contradictory factors, the IRS might conclude the property was really not held for investment. And I won't go into all the details, but there's a decision here, Goolsbee versus Commissioner from 2010. In this one, a taxpayer did a 1031 exchange into a replacement property that they did not intend to hold for investment. And the IRS reviewed this and discovered that they did not intend to hold for investment, and their 1031 exchange was disallowed. In the other decision here, Reesink versus Commissioner, which is a 2012 tax court decision, the taxpayer had an 8-month holding period, and yet the IRS was able to determine that their intent was to hold for long-term investment. So just keep in mind, the time period is just one of many factors that you and your advisor want to review to make sure that you've got the necessary intent to hold for what? Investment purposes or use in a trade or business. What I want to touch upon is something we call the exchange equation. So for full tax deferral, a taxpayer really just needs to meet two requirements. Number one, reinvest all of the net exchange proceeds into like-kind property. Number two, acquire property with the same or greater amount of debt. So those are the two basic rules. Another way of saying this is to spend all of the equity and buy at the same net sales price or greater. So it's another way of saying it. To the extent that the taxpayer receives proceeds, that is called cash boot. To the extent that they have a reduction in the mortgage liabilities, that's called mortgage boot, also referred to as debt relief. So what I mean by that, simple illustration, if I have $100,000 of debt on the property I'm relinquishing and only $80,000 of debt on a replacement property, there's $20,000 of mortgage boot. Now, one caveat I just want to mention, it's not on the slide, but I do want to mention it. A taxpayer can go down in debt and offset that by bringing in new cash. So it can be mortgage boot, but that can be offset by bringing in new cash. So in my example I just had, $20,000 of mortgage boot, but if the taxpayer brings in $20,000 of cash from another source, they offset that and there's no tax consequence. So let me walk through a couple of examples. A taxpayer sells a relinquished property worth $900,000. The debt or the loan payoff, $300,000. Cost of sales, approximately $60,000. So that would be things like real estate commissions, recording fees, fees to prepare the settlement statements, the deeds to the title company, things along those lines, leaving net equity of $540,000. Well, this taxpayer then goes up in value. They buy a replacement property for $1.2 million. Their debt goes from $300,000 to $660,000, so there's no mortgage boot because they went up in debt. They reinvest all of their net equity, so all $540,000 being held by the qualified intermediary is reinvested. So this is an example where we have no mortgage boot, we have no cash boot, and therefore they have full tax deferral. And by the way, as I'm talking on the slide here, I'm showing just buying one replacement property. This would be an aggregate, so you would look at all the replacement properties together. So a taxpayer can sell one relinquished property and buy multiple replacement properties. You'd want to do the analysis then in aggregate for those properties. Now let's look at another example. Taxpayer sells for the same amount, but they buy a replacement property for only $700,000, so they go down significantly in value. The debt goes from $300,000 to $260,000. So here we have $40,000 of mortgage boot, net equity $540, only $440 is reinvested, so there's $100,000 of cash boot. Now you add those two together, and the total boot in this analysis is $140,000. So that's the total amount of boot. And then finally, one last example. The taxpayer in this situation buys for $800,000 and they go down in debt by $40,000, but they reinvest all the cash. So there's $40,000 of mortgage boot. And I want to point this out because I think many investors kind of know intuitively if you receive cash, it's going to be taxable. But it's important that you look at both the cash, does it all go into the replacement property, as well as the debt component. So if you have less mortgage on the replacement property with respect to the relinquished property, that's called mortgage boot, and you pay taxes. So again, to summarize, for full tax deferral, you want to reinvest all of the net exchange proceeds. Number two, you want to acquire property with the same or a greater amount of debt. Now, the general principle when you do an exchange is the tax owner that relinquishes a property should be the same tax owner that acquires the replacement property. So vesting is one way to look at that, although things can get a little bit more complicated when you deal with things like LLCs that are single member LLCs that are disregarded for federal tax purposes. So I could come out as an individual and acquire replacement property in a LLC that is disregarded for federal tax purposes, and it's really the same tax owner. That's what we call a disregarded entity. So the tax owner relinquishes, same tax owner should acquire the replacement property. I've got some examples on the screen there. And again, this is something you'd want to review. Call Asset Preservation. We'd be happy to talk about your unique situation. Certainly review things like the vesting, especially if you're going to be changing vesting with your tax advisor. That's really important. Now what I want to do is get into just a brief overview of the delayed exchange process and the time deadlines on what's probably the most common exchange format, what's called a delayed exchange. So at the top you have the taxpayer. The taxpayer is the investor. Prior to closing, so this is really important, you need to set up a 1031 exchange prior to closing on the sale of a relinquished property. If you've already closed and transferred the burdens and benefits of ownership, it's too late to set up a 1031 exchange. So the taxpayer in a delayed exchange contacts a qualified intermediary. What the qualified intermediary does is they prepare some paperwork and a whole list of documents, but they through an assignment of the contract, they step into the shoes and they sell the relinquished property to the buyer. So the qualified intermediary is the seller. In the first part of an exchange, this happens. The buyer then gives the money to the qualified intermediary, and the qualified intermediary instructs the closing officer to directly deed from the taxpayer to the buyer. Now the qualified intermediary has the money and they're sitting on it. So you'll see this is what we call day zero in a delayed exchange. The taxpayer has up to 45 calendar days, what we call the identification period, to identify replacement property or properties, plus another 135 days for a maximum of 180 days to acquire the replacement property. So the taxpayer does that in the example in the diagram. They then have the qualified intermediary, through an assignment of the contract, step into the shoes as a buyer of a replacement property. So then the qualified intermediary takes the money they're holding, they purchase the replacement property, and instruct the closing officer to directly deed it back to the taxpayer. So in this diagram, you'll see the taxpayer does not sell. The qualified intermediary sells to the buyer. The qualified intermediary purchases from the seller. So the taxpayer is merely giving up a relinquished property and receiving back a replacement property. And that's how they're able to have a 1031 exchange. They're just giving up a property held for investment and then receiving another property, a like-kind property, also to be held for investment. A little more detail on the time deadlines. The taxpayer has until midnight of the 45th day to identify property. So that's the identification period. The exchange period is a maximum of 180 calendar days. When I say calendar days, remember these are going to go through weekends, through holidays. They're just sequential days. So it's a maximum of 180 calendar days, or the date the taxpayer must file its tax return for the year of the transfer of the relinquished property, whichever is earlier. So one thing I want to point out, for those of you that might file your tax return on April 15th of the next year, Anybody that closes right around the middle of October, if you want the full 180 days, you certainly are eligible for that. What you would need to do is file an extension, complete the exchange in 180 days, and then file your tax return. Now, there are a few rules, and I'll go through them fairly quickly in terms of identifying replacement property. There are three separate rules. You can use what's called the three property rule. In this one, the taxpayer can identify three replacement properties of any fair market value. So they sell for $1 million, they identify one at $1 million, one at $1.8 million, and one at $2.4 million. So the value doesn't matter, but you're limited to three properties under the three property rule. Now, there's an alternative known as the 200% rule. Under this rule, the taxpayer can identify an unlimited number of properties, as many as they want. However, the total fair market value and aggregate of all the replacement property identified cannot exceed 200% of the fair market value of the relinquished property. So using the same example, if I sell for $1 million, the taxpayer can identify as many replacement properties as they want, but they can't go over $2 million in value, which is 200%. So the three property rule, the way I like to look at it, you're limited on the number of properties, 3, but unlimited value. On the 200% rule, it's really the opposite of that. It's an unlimited number of properties, but now you're limited on the value to no more than 200% of what you sold. And finally, there's one rule called the 95% rule left, which really, if a taxpayer wants to identify more than 3 properties and more than 200% of the value of the relinquished property, they can do that. However, they must then actually close on or acquire 95% of the value of all properties identified. So if I identify 10 properties, I essentially would need to buy all 10 of them, presuming they're the same value. If I only bought 9, that would be 90%, not qualifying under the 95% rule. So most taxpayers will typically use the 3 property rule or 200% rule, but there is a third rule that's available and can be used. Now on the next slide, I want to go into some more complex variations, and I'm not going to describe these in detail, but these are what we call parking arrangement transactions. They're called that way because we got guidance back in the year 2000, Reg Proc 2000-37, that provided guidance on when a qualified intermediary is parked on title to a property, meaning they're actually on the chain of title to either the relinquished property or the replacement property. So a term that you may have heard of is something called a reverse exchange. This is a parking arrangement where the taxpayer is going to close on the purchase of the replacement property before closing on the sale of the relinquished property. So buy the new property and close on it, acquire it, and then have up to 180 calendar days to sell the relinquished property. An improvement exchange is where a new property is going to be built. It could be from the ground up, could be improvements and refurbishments to an existing property, but some way that property is going to be improved. Again, there's only 180 days to make real property improvements, so there's a very limited time frame to do that. And then finally, there's a parking arrangement known as a reverse improvement exchange. This is where the taxpayer is going to acquire the replacement property and then begin construction on that property, and then have up to 180 days to close on the sale of the relinquished property. So many owner users might use something like this, but these are some more complex variations. Again, we'll be doing other presentations going in depth into the detail and pros and cons of different strategies, but I just want to share that parking arrangements are another form of a 1031 exchange, and more sophisticated real estate investors might take advantage of these different formats. Next, I just want to share with you, we've been talking about Section 1031. There's another section in the tax code that many of you are familiar with known as Section 121. So these are the rules for tax exclusion on the sale of a principal residence. So as you'll see on the screen, Section 1031 provides tax deferral on any property held for investment or used in a trade or business. So the basis gets rolled into the basis of the replacement property. So that gain follows the taxpayer from one property to the next and the next. Section 121 provides tax exclusion up to certain threshold amounts. So provided somebody lives in their house, their principal residence, For 2 out of the past 5 years, if they're a single filer, they can exclude $250,000 of gain. And if a married couple filing jointly, they can exclude up to $500,000. So many that are familiar with real estate probably have heard of these. Well, when we deal with Section 1031, you'll see that there's some different things that can be done. And I'm not going to go into these, but I just wanted to share with you briefly. There's what we know as split treatment, where somebody can sell a property that is partial rental property and partially a residence, maybe something like a fourplex where somebody lives in one unit and rents out three. Um, Fourth variation down, a taxpayer can convert a rental property acquired in a 1031 exchange into a residence down the road. And so it's converting a 1031 property into 121. And then finally, the last bullet point, taxpayers can convert a residence that they've lived in, so Section 121 property, into a rental, Section 1031 property. And there's some other tax provisions to provide. So I just want to let you know this is covered on other presentations. The most important thing that you can do in any 1031 exchange, and probably the most important aspect, is do due diligence on that qualified intermediary. That's the most important thing to look at. An intermediary actually holds your funds from the sale of a relinquished property. So the safety of the funds, the safeguards that are in place, and the security methods, there's nothing really more important in my opinion. I mean, I guess there's compliance with the time deadlines, which is important for tax deferral, but making sure that money is safeguarded is really paramount. There are no federal regulations on the qualified intermediary industry. So you'll see on the bullet point there, the very last one, a number of states, a handful of states, so California, Colorado, Connecticut, Idaho, Nevada, Oregon, Virginia, and Washington, they have put into place state-level consumer protection laws regarding 1031 exchanges and what a qualified intermediary must do in terms of their obligation to real estate investors. But only a handful of states have done that. So in terms of qualified intermediary due diligence, one of the more important things to look at is, does the qualified intermediary offer segregated accounts? You want to have your funds held separate. You don't want commingled funds. You want a separate account set up for yourself, or if you're a real estate professional listening to this, for your client or customer. You don't want the money commingled, but you want a separate account set up for that. And that should require the taxpayer's authorization to open up the account to move funds. Certain qualified intermediaries might offer qualified escrow or qualified trust accounts. You certainly want to investigate the fidelity bond coverage being offered by the qualified intermediary. And many, and I should actually say most reputable qualified intermediaries, they belong to the only national trade association. It's called the Federation of Exchange Accommodators, sometimes referred to as the FEA. And members of the FEA subscribe to a code of ethics regarding the treatment of the funds and other aspects. So you might want to find out, does that intermediary belong to the Federation of Exchange Accommodators? Their website's a very easy one to remember. It's 1031.org. And then finally, to kind of wrap things up, I've gone through this fairly quickly. You're certainly welcome to contact Asset Preservation. In fact, to review your specific 1031 exchange situation, contact Asset Preservation's headquarters in California at 800-282-1031 or our Eastern Regional Office in New York at 866-394-1031. Feel free to visit our website, apiexchange.com, or email us, info@apiexchange.com. That's an email that's monitored by senior management. And just remember, Asset Preservation cannot provide tax or legal advice. So a proper evaluation of all the benefits and risks associated with a particular transaction or tax return position often requires advice from a competent tax and or legal advisor familiar with your specific transaction objectives and the relevant facts.